Hi guys, this is Marat here from the Lending Group. I wanted to spend a little bit of time talking today about the rate hike last week and see if I could discuss how it affects your everyday life and how it affects the mortgage rates and the bond rates. So if you didn't already know, last week the Federal Reserve has increased the short-term borrowing rate by 0.25%. What does that mean and how does it affect you? So number one, as many of you may have known, the Fed has been fighting inflation, and you can see that at the pump. Oil prices have gone up, durable goods have gone up, raw materials have gone up, and it's causing inflation. Inflation is the worst thing for the bond market and for mortgage rates. On top of that, the Fed is now fighting the situation in Russia and Ukraine, and which is causing additional pressure on the prices of oil, and it has been increasing those prices. So as you can see, the mortgage rates have also been going up over the last several months. And like I said, they are going up due to these pressures. Number one, inflation. Number two, the war in Russia. And also the very, very short supply chain, meaning the product in the supply chain, the lack thereof, are hurting us. What does that mean to you? What does it mean to you as the agent, you as the borrower, and us overall? My recommendation is, if you found a house that you like, that you can afford, and that suits your family, you should absolutely positively lock in your rate. So I want to talk a little bit about budget rather than interest rates, okay? We're so concerned about the rate. Is the rate going up? Is the rate going down? So please keep in mind, the rates are still in the 4s. Historically, those are really low rates, and in many cases, these rates are pre-pandemic rates. So don't spend so much time concentrating on what's today's rate. Let's talk about the budget. Can you afford $1,500 a month? Can you afford $1,800 a month for your mortgage payment? And if the answer to those questions is yes, please speak to your lender, lock in that rate, because the rates are fluctuating once and twice and sometimes 3 times a day. And I'll give you a perfect example. I had a borrower that was having some technical difficulties and couldn't sign documents or disclosures. And from March 15th to today, the rates have really moved, and she was very close to being out of her budget. And so I really don't want that happening to anyone. And like I said, I recommend spending the time and really concentrating on your budget. And at this point, also maybe thinking about adjustable rate mortgages. I know they're not ideal, but if you're not going to be in the property for 30 years, maybe it's time to think about a 5-year adjustable rate mortgage or a 7-year adjustable rate mortgage, and make sure that you can choose a rate that suits your budget. So concentrate on the budget rather than the rate. Again, just a little bit of an overview. Last week, we had a federal rate increase of 0.25%, and the reason that's happening is because the Fed is fighting inflation, which is terrible for the bond market and terrible for the mortgage rates. Also, the situation in Russia is hurting us. So because the market is so volatile and it's changing several times a day, I really, really strongly recommend locking in your rate as soon as possible. Talk to your local lender, talk to your mortgage professional, get that rate locked in, and please understand what you're shopping for. The lowest rate is not always the best option. In many cases, it is the most expensive option. And in many cases, you don't really need the lowest rate. So know what you're shopping for, know what your budget is, pick a house that you like, that you can afford, that fits into your budget, lock that rate in, and try to win the contract. Again, if you have any questions, please reach out to me at meetwithmarat.com, meetwithmarat.com. Agents, if you want to discuss adjustable rate mortgage products, please reach out to me as well. I'd be happy to help you. Thank you. Take care.